Vertical spreads rely entirely on price direction, while calendar spreads profit primarily from passing time and rising volatility. Many traders treat these two strategies as interchangeable because they are both debit trades with defined risk. However, they profit from completely different market environments. If you use a calendar spread when you should have used a vertical, a correct directional move can actually result in a loss. Let's start with the structure of the vertical spread. This is a pure directional play where you buy one option and sell another at the same expiration but different strikes. You are reducing your cost basis to bet on the stock moving from point A to point B. The mechanics are straightforward. You cap your potential profit to lower your entry cost. Your maximum profit is realized if the stock price moves beyond your short strike by expiration. Time decay usually works slightly against you or is neutral. In contrast, the calendar spread, often called a time spread, involves the same strike price but different expiration dates. You sell a short-term option to collect rapid time decay while buying a longer-term option to protect the position. Mathematically, the calendar spread is a volatility play. Since the long-term option has more Vega than the short-term option, the strategy benefits if implied volatility rises. It essentially capitalizes on the difference in decay rates between the 2 months. Here is the critical distinction regarding market direction. A vertical spread needs the price to move. If the stock sits still, you will likely lose money due to theta decay on your long option. It is an active directional bet. Conversely, the calendar spread creates a tent-shaped profit zone centered on the strike price. You want the stock price to remain relatively stable near that strike. If the stock explodes in either direction, the trade moves outside the tent and loses money. Let's analyze the Greek exposure, specifically Vega. Vertical spreads are relatively insensitive to volatility changes because the long and short options cancel each other out. A calendar spread is long Vega, meaning you need volatility to hold steady or increase. This brings us to the volatility crush danger. Many traders mistake calendars for earnings plays. However, if implied volatility drops significantly after an event, your long-dated option loses value faster than the profit you made from the short option. Therefore, never buy calendar spreads in a high volatility environment that is expected to drop. You want to enter calendars when volatility is historically low and expected to rise, or simply return to the mean. Now consider the break-even points. A vertical spread has one clear break-even point. Once the price crosses it, you are profitable. It is binary and easy to visualize on a chart. A calendar spread has two break-even points, one above and one below the strike price. However, these points are fluid. They change based on how much volatility rises or falls, making the exit target harder to pin down exactly. Let's look at capital efficiency. Calendar spreads are often cheaper to enter than vertical spreads of similar width. This offers a higher potential return on investment if the stock pins the strike perfectly, but the probability of a perfect pin is low. So how do you choose? Start with your directional assumption. If you have a specific price target in mind, e.g., stock will hit $150, the vertical spread is the superior tool. It captures the move directly. If your assumption is the stock will hang around $150 for a few weeks, the calendar spread is the winner. It turns a lack of movement into profit, which a vertical spread cannot do effectively. Next, check the implied volatility rank, IVR. If IVR is under 20, options are cheap. This favors the calendar spread because you are buying the expensive back-month Vega at a discount. If IVR is high, you should avoid calendars. A vertical spread is safer here because you can structure it to be less affected by the inevitable volatility drop, or switch to a credit spread instead. Management differs greatly too. Vertical spreads are often set and forget until they reach a profit target like 50%. You usually close them or let them run. There are fewer moving parts to adjust. Managing a calendar is more active. If the stock moves too far, you might need to roll the strike price to follow the stock, essentially moving your profit tent to where the price action is. Let's summarize the perfect setup for a vertical spread. You see a breakout pattern, IV is average or high, and you want to find risk without worrying about time decay eating your profits immediately. The perfect setup for a calendar spread is a stock finding support at a major level. You expect it to chop sideways. IV is low, and you want to profit from the passage of time while waiting for a potential volatility expansion. A final warning on expirations. For calendars, ensure your short strike is at least 20 to 30 days out. If you go too short, like weekly options, the gamma risk becomes dangerous, and a small move can wipe out the trade. Ultimately, don't force a strategy. Let the chart and the volatility environment dictate your choice. Use verticals for go markets and calendars for pause markets. Here is the summary table comparing the Greeks and ideal environments for both strategies. Screenshot this for your trading plan. Remember that mastering both gives you a tool for every market condition. Trade the environment, not just the stock price.